Hello, everyone. This is a global supply chain outlook for 2022 and beyond event hosted by Institute for Supply Chain Excellence and Innovation at University of California, San Diego. My name is Shin. I'm a faculty member at UC San Diego, doing research in supply chain management, focusing on information and demand forecasting. I'm also a faculty director for Institute for Supply Chain Excellence and Innovation. And welcome everyone, first of all. And this event is the first event focusing on the global supply chain outlook. However, not the last. Okay, we plan to host this event every January to provide our thoughts on the supply chain outlook, including industry experts in various sectors. To start with, in today's webinar, we have various keynote speakers as well as the panelists from macroeconomics perspective, and also from semiconductor industry, as well as from the pharmaceutical industry. With that, our first welcome remark will be given by Jimmy Encaseria. Jimmy has been in the industry of supply chain over 3 decades, working with numerous Fortune 500 companies, resulting in a lot of cost savings of several billions of dollars. And Jimmy is also the author of 2 books in cost management in supply chains. Lastly, Jimmy also is a great supporter of UC San Diego. With that, Jimmy.
Thank you, Shin, and hello, everybody. It's such a pleasure to be able to kick off this first of the year, but also to begin what I hope will become a tradition here at UCSD and the Institute for Supply Excellence and Innovation. When I think about supply chains and crises and stuff like that, I realize it's all a question of how much gray hair you have. And if you can see that, I've got a lot of gray hair, which means I've been through those ups and downs over the last 35 to 40 years. The difference between this particular one and the innumerable crises that we've experienced in the supply chain world is that this one has brought supply chain not only to the limelight of the CEOs and the C-level, but to every human being virtually on the face of the earth. So I don't look at this as a challenge. I look at this as a phenomenal opportunity to really bring out what the world of supply chain has actually had, harvested, produced, and delivered, but hasn't been recognized. And now finally, we are beginning to see this. But, when anything happens in sort of a negative way, there's always a positive side to it. And I look at this as an opportunity to show where the value of supply chain can be. I'll be honest, in my own experience, and I go back quite a few years here, having been an entrepreneur, being in a conglomerate that owned a lot of companies, and being at a very young age in the so-called board seat. I'll be very honest with you folks. I always looked at supply chain, procurement, purchasing, whatever word they used at that time, as one of those back-end type things where they didn't really add any value. It was always like the engineers decided what we wanted, threw it over the fence and told the people in supply chain, go buy this and get it to me tomorrow. Okay, there was never really any strategic value. And how times have changed. The very fact that the words have changed. Purchasing became procurement, procurement became supply chain became integrated supply chain. Now we're talking about value chains. Then we've added digital value supply chain. So the words keep coming, but the process is still the same. The process is most importantly getting across organizational boundaries. What I call developing and harvesting the inherent knowledge of the extended enterprise. And the extended enterprise is all the stakeholders within a certain company, their customer base, and their supply base as far back as you can possibly go. And there is tremendous effort to be put in to harvest that knowledge. It's about harvesting, obviously, intellectual knowledge, but also the personal touch and bringing out what we call that corporate CQ. So I think today what you're going to hear from an unbelievable group of people here is where do these different industries see their value in providing better solutions, solving problems, because that's the name of the game. It's not just being there and existing for the sake of existing. It's always based on there is a problem, how do you solve it? And I go back again to history where it says problems are solved when you have good people with good processes. And I think what you're going to hear today is whether it's a Dell or a GSK or in the World Trade Organization or anywhere else, there are good people, we have good processes, and the time is right. I can't wait to hear the rest of our panel today and turn it back to Shin. But thank you again on behalf of ISEI. We look forward to your continued participation, not only today at our various webinars, but also at our Oceanside chats. Thank you, and back to you, Shin.
Great, thank you very much, Jimmy. Jimmy is also the founder of this institute and chair emeritus of this Supply Chain Institute. With that, I'll move on to Al Pisano. Al joined Jacobs School of Engineering as a dean in 2013, and he also holds the Walter Jables Chair in Engineering. And Al is a highly accomplished mechanical engineer, and he was elected to the Fellow of National Academy of Engineering, as well as National Academy of Inventors. And as a self-described technology polymath, Al's research is driven by his passion for developing, mastering, and advancing technologies in order to solve problems. That sounds really at the heart of supply chain as well. And since Al was the dean of the Jacobs School of Engineering, in the past 3 years, Jacobs School of Engineering has been ranked as a top 9 engineering school in the world. So with that, Al.
Great. Shin, thank you very, very much. I appreciate the warm intro. Ladies and gentlemen, I'm very happy to be offering some opening comments. The first comment I want to offer is I am pleased and grateful to be part of this forum today. The School of Engineering is the new home for ISEI. We are in full partnership with RADI, and as time goes forward, we hope to have more and more parts of the UC San Diego campus deeper and deeper involved with ISEI, reflecting some of the comments that Jimmy made, which is digital value supply chains really span now more and more disciplines as you try to deal with the supply chain challenges of the future. I want to offer that a few years ago, engineering started a systems engineering program, and we see great synergy between systems engineering and digital value supply chains. Indeed, we'll be having exciting news going forward about how these two programs will be working closer and closer together. So let me make my comments brief and to the point. I'll finish in a moment by saying I reiterate that I'm truly happy and honored to be here with everyone today. I'm going to be listening and learning as well. And I personally hope that this special meeting, the Global Supply Chain Outlook, becomes an annual event. And so thank you, Shin. I appreciate it. Thanks, everyone. Good morning.
Thank you very much, Al. With that, we'll move into our main agenda for today, which is Tom Derry's keynote speech, as well as panel discussions moderated by Tom. Tom is a CEO of Institute for Supply Management and also co-chair of ISEI. And Tom has been in the industry, in this supply chain industry over, again, 3 decades of experience in leadership, as well as general management roles for public and private companies. And not only in the for-profit companies, but also in nonprofit sector as well. And he has executed turnarounds at the corporate and business unit level through a variety of means, including acquisitions, divestitures, restructuring, as well as business process reengineering. With that, I'll ask Tom, but for the audience, if you have any questions, please use the Q&A button to ask questions. We'll try to answer as many questions as possible if time permits. With that, Tom.
Thank you, Dr. Shin. I'm going to share my screen now. Good morning and good afternoon to everyone, depending on where you are in the world listening to this. I think we have a global audience, which is very appropriate. I'm going to apologize in advance. I have a lot of data that I want to share with you today, and I know it will be rather quick, because I want to get past the data. Some of the data may be familiar to many of you in the audience, but I want to get past the data. I want to set the table really for the conversation that we're going to have with this extraordinary panel. I want to point out that arguably the two industry sectors most at the center of this pandemic crisis story are pharmaceuticals and electronics. And we've got two experts representing those two industry sectors on the panel today, along with a renowned international trade economist, Caroline Freund, with a previous background before UC San Diego at the World Bank, the IMF, and the Federal Reserve Board. So got an outstanding group of people to put some of this data in context and explain it. I usually begin my remarks by showing this slide. It shows over 20 years of history of the correlation between the PMI indexes that we publish at ISM, which are widely followed by the White House, by the Fed, by academics and policymakers. There's a very tight correlation between the manufacturing PMI, which is this orange line, the services PMI, which is represented by that gray line, and then change in GDP, US GDP, on a quarter-over-quarter basis. And you can see very, very noticeably the two most recent recessions outlined on this particular chart, and also the very remarkable and very rapid recovery and following April and May of 2020, when we recovered very rapidly from the brief COVID lockdowns and saw a real resurgence in the economy. I do that sort of to establish credibility. Arguably, the PMI data is both the most timely and most reliable indicator of where the US GDP is at any moment in time. You don't have to take my word for it. Alan Greenspan once said that himself. Moving to the next slide. If I can advance it here. There we are. This shows the recessions, and I'd like to share this because we publish the data on the first business day of the month and the third business day of the month. And in those reports, I encourage you to go grab them on the ISM website. We correlate the headline index number, it's a diffusion index, with the growth of GDP growth rates. And we can do that because we've got more than 80 years of history in the manufacturing sector and about 30 years of history in the service side of the economy. And if you know that the US GDP is comprised about 88% by services and 12% by manufacturing, you can do a quick weighted average calculation. And as you can see here, using the most recent data, US GDP is currently running at about a 6.7% rate, which is a very, very strong number. And we had two important economic announcements that came out yesterday. GDP for the full calendar year 21 ran over 5.5%. The government reported yesterday, which is a very, very strong number, and picked up a little bit in the fourth quarter in particular. And we also had a very interesting earnings announcement from Apple. And I'm going to get into that a little bit because some of Apple's comments during their earnings announcement yesterday, they had record earnings, goes specifically to the insights that this data will kind of tee up for you. Now, there's some good news, sort of a good news sort of scenario in that as strong as the economy is, backlogs, and we report backlog data in our report, remain at very high levels for recent years and historically. Manufacturing backlogs are 62.8%. Again, it's a diffusion index, meaning that 62.8% of firms are seeing their backlogs stay the same or increasing. And the same with the services sector. We know, and we'll get into this a little bit, that there are supply constraints holding back performance of the economy. There are shortages of commodities, the shortage of labor. We're having to pay more for labor. Transportation continues to be an issue globally. And capacity utilization, by the way, is running near 90% in the United States. So arguably, despite supply constraints, we're approaching a realistic level of maximum capacity output in the US economy. The reason that's arguably good news is plenty of demand for companies to fulfill in the coming year. They'll be working off these backlogs for most of 2022, if not longer. And arguably that means we can look forward to an extended period of economic growth in the United States because the out months look pretty good, no matter which side of the economy you're in the United States. We also know that inflation is here to stay. And I'm sorry, Fed Chair Powell, I don't think it's transitory. And I think he's coming around his point of view on that as well. This is data that correlates the change in the CPI for urban consumers with the inflation data or prices data that's reported in the services side of the economy. The services side of the economy is 88% of the U.S. economy, so naturally we're going to look to correlate there with the largest portion of the economy. You can see that the CPI ticked up with a diffusion index of over 70, but frankly at a rate, let me move this box so I can see the full chart myself. Approaching well over 1% as of September of 21. And you see that they move very closely together. Inflation is something that we're going to have with us for a while. Some economists would make the point that since inflation is measured on a quarter-over-quarter change basis or a year-over-year change basis, that because the denominator is now higher, we should see the rate of inflation growth decline throughout 2022. I don't know many business executives who are as optimistic about that. They may understand the math. They continue to see significant price increases in the value chain. I'm going to point out what I think is the reason for this. In our conversation, our conversation preparing for this talk today, Caroline Freund brought this up. People initially began to think of the situation we're in as sort of started as a supply side issue, and arguably in March of April of 2020, with very pronounced lockdowns in the Hubei province of China and elsewhere in China, we did have a supply constraint problem that kind of created the exogenous event that caused economic growth to plummet. But as she said, it's really more of a demand issue now. This is data from the Cleveland Fed, which shows the typical change in the real personal consumption expenditures for durable goods. So think washing machines and automobiles for consumers in the months since a recession. The typical average from 1959 to 2019 is represented by that dark blue line. You can see that it doesn't move much, typically, up to 14 months or a full year after the onset of a recession. But this pandemic was very different. We had a very sharp decline. People didn't know what to expect. And we had a very sharp increase that's lasted for more than a year, right? It began 2 months out. We crossed back to where we normally would be. And the data has basically climbed ever since then. Meanwhile, real disposable income at the household level has also been very high, much higher than historical precedents would show. It's been coming down a little bit, and government fiscal policy is now run its course, and we're not getting extra checks from the government anymore. But these conditions, we weren't spending money on services, we weren't commuting to work, we weren't buying as much gasoline, and the government was sending us checks. So we were all sprucing up our homes and backyards, buying new electronics to work from home or go to school from home. And we've had very, very strong shift in the demand curve. And that's one of the major reasons for the supply chain issues that we've been experiencing. I won't spend a lot of time on this slide. I think it's very interesting also from the Cleveland Fed. The changes in durable goods spending very closely correlate to the 3 waves of stimulus, including the most recent wave of stimulus back in March of 2021, almost a year ago now. So it's quite clear that government fiscal policy accelerated the recovery and the demand. You could argue whether it was more than needed. I mean, that's a policy question that could be debated, but it clearly had an accelerating effect on economic performance in the United States and arguably for the rest of the world. Now, I wanted to just show you something that the main point of this slide, I apologize, it's a little busy. We report every month on commodities up in price or in short supply, or both, as it turns out. And you can see the list here for the most recent report on the right-hand side of my screen. And the key thing to take away is it's everything. It's not just one category. It's not just one commodity. It's everything from metals to electronics, to corrugate for packaging, to resins and plastics and petroleum-derived chemicals, to glass bottles, to paper products. It's everything. And one of the reasons inflation has flowed through the value chain is that it's not just any single commodity. It's not just that copper went up and somebody had to figure out how to deal with rising copper prices. It's everything you buy, including, by the way, what you pay for transportation, what you pay for logistics and warehousing, what you pay for labor, and what you pay for energy. So that's where we are right now. Prices are increasing both upstream and downstream. This is data that ISM has collected this month and has not yet been published. So you're actually seeing the first audience in the world to see some of this data. People are working hard to mitigate price increases in their businesses, and they've been conditioning their customers to expect price increases. one of the most interesting phenomenon, I think, is that there's been very little resistance when suppliers approach their customers about the need to raise prices. Normally, that's a very tough conversation between a supplier and the buyer. But everyone understands that inflation is here and they're accepting these price increases. Eaton announced that it's going to have 30% price increases for its industrial power products going into effect next month. 30%, a pretty astonishing number. And so here's the data from the Bureau of Labor Statistics that shows kind of embedded in the middle of the value chain and the supply chain. So this is the producer price index for unprocessed goods. These are the components and the ingredients and the assemblies we buy in procurement that end up in our final products. Look at that number in the spike for July this past summer. At one point, the overall PPI for these unprocessed goods was running 60% higher than 12 months ago. It's not seasonally adjusted data, so that's just a raw number. 60% higher. It's astonishing. It's improved slightly since the summer, but it's still running at very, very high levels. This is also PPI data. This is looking at some of the components of final demand. We've all been talking about transportation logistics a lot over the last 2 years. Look at the price increases. This is seasonally adjusted. I'm sorry, not seasonally adjusted data. Look, we're paying anywhere 20% higher for airline passenger services on a year-over-year basis. Air transportation freight is in the high single digits. Water transportation freight approaching 20% higher overall. Truck transportation, a chronic shortage of truckers and trucks in this country, running 20% higher than 12 months earlier. We're paying a lot more to move stuff. Frankly, over the last 30 years, when China became the world's manufacturing hub, we didn't think about moving products by ocean freight from China as a significant component of cost. It certainly is today, and many of you have probably heard anecdotally that the cost of moving a 40-foot container from any of the East Coast ports in China is as much, if or not greater than the value of the products you're moving themselves right now. It causes companies to really think about that equation going forward. Now, what are the biggest concerns that companies have? Well, hiring and labor is a huge issue. Notwithstanding the very low unemployment numbers reported for the U.S. economy, below 4% right now, we still have labor participation at kind of historically low levels. And it's true that many people left the workforce during the pandemic, so that we have a wave of early retirees or people who are dealing with supporting older relatives or had childcare issues, kids who weren't in school. So actually, the labor force in the United States is arguably a little bit too small to support the level of demand. In fact, job openings are something like 14.5 million right now in the U.S. economy, and people looking for work only number about 6. So we have a chronic shortage, and that's particularly true in supply chain. It's particularly true in places like distribution and warehousing, and in trucking, and in shipping. So it's going to be a significant problem for companies who need to move goods from other countries and within the United States itself. I heard an amazing statistic the other day. Ryder transportation systems, you probably have seen Ryder trucks on the road. They operate a fleet on themselves, and they lease trucks that they build to other companies. They also have a supply chain outsourcing business. It's about $1 billion a year business, and they run distribution centers for companies on a third-party basis. At full employment, that Ryder distribution business employs about 26,000 full-time equivalents. They've had to hire 21,000 people into that workforce over the last 12 months. That's more than an 80% turnover in that business. So labor shortages are continuing to be a significant concern for many companies going into 2022. You're going to see higher wages, and higher wages could spill over if the source of demand or the source of inflation came from the value chain in the past year. If it spills over to the consumer side and inflation expectations become unmoored, economists would say, that could be an argument for continuing inflationary pressure in the U.S. economy going forward. Now, while lead times have improved, and this is brand new data, they're still arguably almost twice as high as normal. So that's what these percentages indicate. Even if you're moving products from Mexico, it's taking 88% longer than it normally would to come into the United States. You can see that China is still over 216%, still twice as long to get product from China 2 years into the pandemic as it normally would be. Vietnam is over 200%, Africa over 200%. So lead times are not really improving. How do companies respond to lead times being this high? Well, they're increasing their inventories. People make the argument that we're moving from an era of just-in-time inventory practices to an era of just-in-case inventory practices. 53% of companies tell ISM they're increasing their safety stocks. And by the way, I read an academic paper recently from a professor at Michigan State that indicates if you're relying on your ERP system and the formulas embedded in that to indicate your proper level of safety stocks, it wasn't designed for the current economic conditions, and it's underestimating, the formula is underestimating your safety stock levels. You might want to take a look at that. 47% of people say they're also intentionally holding more inventory than usual. I like the next to last entry here too, unintentionally holding more than usual. To me, that indicates not lack of demand, but higher levels of work in process inventory. I'm not clear to build because I'm missing a single component. And so I've got a nearly finished product sitting on a warehouse shelf, but I can't ship it to my customer. Apple, I mentioned Apple's earnings announcement yesterday. Apple announced record revenues and profits for the quarter ending in December, over $120 billion. But they also said that sales would have been $6 billion higher if they had all the product they needed in their supply chain to ship more phones. Think about that, $6 billion in foregone sales because you didn't have components in stock, couldn't get them. That's a big problem, right? I mean, $6 billion, that's a big company. It's an asterisk for Apple, but it's a big company by itself. This is an indication, this is real company data. I have to mask the firm, but it's an industrial manufacturer. There's two key metrics. I asked this person who runs a supply chain organization, can you tell me what pre-pandemic KPIs look like and what, in the depth of the pandemic, what the KPIs look like, and give me an indication of the impact. So normally, this firm which ships highly engineered products to its customers, its goal is to ship to the customer 95% on time, defined as the customer's request date for that delivery. And its normal operating cadence is typically in the 92 to 94% range. They do pretty well. If it gets below 92, it's a major Kaizen event in that company. What's going on? Why can't we deliver to our customers on time? And they're currently operating at 79%. Now, this is a lagging indicator, obviously, because by the time you can't fulfill your customer's request, the issues have already happened historically in your business, right? So you have to go back and look at that and examine and figure out what it is. One of the things that is happening, this is this leading indicator, the past due backlog. This is the backlog of inputs to this particular manufacturing company. Normally, in a good year, normal year, only 0.5% of their inbound supplies are late past their delivery date. Running right now at 2.7%, so a 5 times worsening of performance, which this person told me on a quarterly basis, running at this level means it's a 3% decline in revenue per quarter, which compounds obviously to more than 12% on an annual basis. So now, arguably, in the case of Apple and its $6 billion in missed sales opportunity, arguably you're not seeing a decline in revenues in an absolute way, but you're seeing a decline in the opportunity to grow your revenues, right? Because you're not clear to build, you can't ship to customers, and you're not making sales. Linking that back to the backlog data I referenced earlier, in some ways, arguably, this is a good sign that the strong economic performance we're enjoying should continue throughout most of 2022, but companies are leaving money on the table, and it's due to supply chain issues. Now, I thought this was very interesting data. I wanted to point to the line here in the middle of the table. Again, this is unpublished, but if you look at the data for China, 62% of firms say they have a major supply chain presence in China. That's no surprise when you think about the global economy. 30% of companies tell ISM they have planned a shift away from supply chain operations in China, or the shift is already underway. We've talked about a China plus one strategy on these calls, and the ISEI has published data on this before. This is confirmation that it's happening. We're in the process of seeing a significant realignment of global supply chains. And I'm dying to hear what our panel talk about that. Now, I don't want to overstate it. People talk about reshoring and nearshoring. I know that my view is shared by some of the panelists, and that's not really going to happen. But we are seeing, for instance, Mexico grow and win supply chain market share from China. The Dallas Fed has published data indicating that. So there is going to be a realignment, and part of it is risk related. Part of it is we're now operating in an era of geopolitical rivalry. That has not been the case over the last 30 or so years. People are uncomfortable with the arbitrary rule of law sometimes in places like China. They're uncomfortable with the potential for risks and disruption, and they're willing to consider building more cost into their supply chain by having that secondary supplier, not a sole source or single supplier, in order to be more resilient and less prone to disruption and risk. So what are the top issues? You had to rank these issues from 1 to 10. If you ranked it 1, that means it was your highest concern. Therefore, on an average basis, a 4.2 means it's the lowest overall score, meaning it was the highest ranked concern by companies. And delays in shipment and supply, no surprise really based on the data we've seen, continue to be the #1 concern, followed very closely by limited availability of raw materials. One thing I find really interesting, and maybe we'll be able to discuss it. You may or may not be aware of a law signed into law by President Biden in December called the Uyghur Forced Labor Prevention Act in December 23rd. It makes it illegal to import products from the Xinjiang province of Russia based on the assumption that the government has kind of shifted the burden of proof to companies. We're going to assume that the goods you're importing have so-called benefited from forced labor conditions in that province, unless you can concretely prove to us that they didn't benefit from forced labor. The burden of proof, though, is on the company. Otherwise, your goods are subject to confiscation and you're subject to paying hefty fines. Well, more than 50% of the world's supply of silica, which we need to make semiconductors and a lot of electronics, comes from that province today. If I can't, and if I'm buying let's say I'm buying my chips from TMSC in Taiwan, Taiwan is sourcing the silica from that province, I still can't import it. It's still illegal. What are we, with the chronic shortages that we're already facing in the electronics industry, how are we going to deal with this economic reality in 2022 going forward? It's something to really be thought about and planned. If you're not already thinking about UFLPA compliance, you should be, in my view. And I'm going to stop there. It looks like I'm more or less right on time. They've got a very distinguished panel. I can't wait for you to hear from them. And I'm going to stop my screen sharing and bring up our panelists. And we're going to get right into it. So I've got with us today Caroline Freund. I mentioned her background as an expert in international trade. Can't wait to hear her views on this. Her world has really changed in the last couple of years. Piyush Bhargava, who is a 20-year career at Dell in the electronics industry. He's worked in 3 different countries around the world, so he's got a global view on what's happening. And finally, Vince Ricevuto, who's here from GlaxoSmithKline, who's got a lot to say about the pharmaceuticals industry. And as I mentioned early on, both electronics and pharmaceuticals, because of their criticality in this economy, in today's world, have gotten more than their fair share of attention, not only from consumers, but also from governments. And I think I wanted to begin there. I think I wanted to begin with, typically we've been, in supply management, we've been focused on opening new country markets, keeping our companies up and running efficiently, keeping costs low. And there have been some other benefits that have come from that. We've raised the standard of living in countries around the world where we've opened operations. But it seems we're entering a new era where compliance is becoming equally important. Whether it was conflict minerals and that legislation came out of Dodd-Frank in the wake of the 2008-2009 recession, or the Uyghur Forced Labor Act I just mentioned, or the Modern Slavery Act out of the UK, similar legislation in the United States. I just want to begin there. Are we entering a new era where politics and geopolitics are creating a framework or environment where it's going to impinge and impact on our ability to operate supply chains the way we've been accustomed to? Piyush, if you don't mind, I'll begin with you on that.
Yeah, thanks, Tom. Now, it's been an interesting last few years. to look at the trade through the lens of what's staying the same and what's changing, right? Most in the practitioner trade would say there's been a lot of drama and a lot of trauma, right? And that's the way I would characterize the last 2.5 years. The thing that has, and you touched on it briefly, what started out as a supply chain disruption or discontinuity that was triggered through the pandemic soon became a demand-driven crisis, a lot of which was unprecedented, right? And within that context, on your question on the things that will change and are there emerging trends that will look different going forward, I think there's 3 things that I'd like to touch on. First is the role of the government, right? The geopolitics around what we are seeing in the supply chain will continue to get exacerbated in ways that we haven't seen before. I think the push to nationalism is one aspect of it. The role that corporate and public sector will play together in combating some of that to build more resiliency in the supply chain is an aspect that I think we're going to have to live through. And the role of the government, whether it's through manufacturing incentives or incentives around net zero as ESG becomes more important, I think is more dominant in the future than ever before. There's an aspect around the workforce as well. We've talked about the number of people that are leaving the workforce. Supply chain is no exception. And therefore, the role that we'll have to play around creating purpose-driven employment, the ability to retain, recruit, retrain folks to the emerging needs of the business, I think is going to be a really important one. There's pieces around, and you talked about sort of stricter measures around human rights, et cetera. I also see an aspect around cross-border data transmission, right? As security becomes a critical element of how people think about their supply chains, I think data flow across cross-border issues is going to become more and more dominant as well. So I think all of those things play well into what may continue to be an evolution in the trade. We've talked about how the acceleration of the digital transformation has happened. What was conceived to be in the next 3, 5, 10 years is here upon us now. And so some of the trends that we were tracking to be out in the future, we are having to comprehend, all made more complex by some of the things that I just mentioned. So let me pause there and maybe hand it over to Vince and Caroline to add to it.
Yeah, Vince, what's your view on those comments?
No, I think first, I'd like to further elaborate on the demand piece that we've been navigating within the pharma supply chain. And we know the unprecedented lift across the supply chain to bring vaccines to market at record pace. And just to put that in context, from a pharma supply chain standpoint, the pursuit of the vaccine had brought an uplift of over 20% when you just think about glass vials. And so when you take a look at that, along with how quickly companies have had to partner with each other to fill this product at record speed, that's further created an upstream set of demand. And in many cases, some of the parts that are used to fill the vials, for example, and make the product have doubled, tripled. And when you further magnify that upstream, it's definitely created a VUCA environment. The volatility has never been greater in my career working in pharma and in supply chain. Additionally, along the way, we have to make sure that in the pharma industry that we continue to serve our patients. And there's many other medically critical medicines that need to be continued to be supplied. And you talk about government policies. One of the things that was new for us was around the Defense Production Act. And we had to effectively work with our supply chain partners to try to understand what was that implications, where basically orders were being reprioritized. We had trucks redirected, and how you have to navigate in that environment really puts pressure and really drives the importance of supply chain fitness and really trying to make sure that you're constantly building resilience. I just want to, before turning over to Caroline, I do think, while we as supply chain professionals have a lot of headwinds in front of us, I truly believe this is the decade of the supply chain professional. We've never had a better opportunity to navigate through this, show leadership, and really drive growth in these markets, show a competitive advantage, and also do things differently. And as we go on, be happy to kind of share some of the things that we're doing differently in this area to ensure that we're best serving our patients and consumers.
Caroline, if you wouldn't mind commenting on that, and I also would like to hear you kind of manage our expectations. I did mention that the data suggests that there's some realignment of global supply chains happening, but I think it's to a limited extent. I think that's a view that you hold. So you could comment on that as well, please.
Sure. I just want to emphasize first the point on demand. As much as we hear about supply shortages, surging demand is the real culprit, which also means when we think about policies to realign supply and demand, it's probably more about stimulus and interest rates, frankly, than it is about improving logistics and investment, because that stuff can't happen overnight. As you noted, Tom, the just released GDP data was 5.7% for 2021. That's more than a percentage point above even the most optimistic forecasters at the beginning of the year. And we also saw this huge shift to goods, containers, for all the constraints at LA and Long Beach. They were up 16%, highest on record, since the highest on record in 2018. So basically, everything is surging. So while you can say companies are leaving money on the table, sure, if they could expand supply, but there are constraints, and that simply just can't be done overnight. So I really think that we need to emphasize the importance of demand, and in particular, the shift to goods, because, people stopped going to the gym, they bought Pelotons, people stopped traveling, they remodeled their house instead, et cetera, stuff like that. But I think the other big issue is uncertainty. And in fact, this was already happening even before COVID because of the policy predictability. And in some sense, that helped prepare companies to start already thinking about their supply chains. But the problem with uncertainty that fits with the supply issue is the optimal strategy is to wait, because you don't know what's going to happen next. So there's an option value of holding off. There's also a difference between this and other crises because no capital was destroyed. So it's not the case like after a hurricane or earthquake where you need to immediately think of rebuilding. Your existing capital is still in place. So I don't think any switches. So to get to your point, when I was at the World Bank, we did some surveys of companies, and at the beginning, they were saying, if anything, decline in investment. That's when everybody thought demand was plummeting. They were really worried about that. Now you see more of an increase, but the biggest group is just sitting on the fence, waiting to see what's going to happen with policy, waiting to see what's going to happen with COVID. And I think that's a problem for expanding supply. And then finally, just to say a few words about policy and then to keep the conversation going. There is obviously the US-China trade conflict as the biggest part, but right now in a period of inflation and when there's so much uncertainty, I just personally don't see a lot of change because there's huge recognition on the need for all the imported inputs. Consumers benefit from lower prices and more varieties. So to start changing that in a bad direction would be unlikely. I think Piyush mentioned nationalism. That's the threat from the policy perspective that I would be most concerned about, is all the buy local stuff and things like that. I'll stop there.
Okay, that's a very interesting point, because even in the United States, there has been conversation in the Biden administration about so-called industrial policy, which is something that we have not typically been in favor of here in the United States historically, right? We don't like the government.
And most economists still aren't in favor of it.
Yeah, right. But China, France, they're very open about it, right? And China in particular has declared certain industries, semiconductors being one of them, to be strategic importance. And there's a move, it appears. I mean, I understand that consumers and citizens feel vulnerable in a way that they didn't appreciate before. Most consumers didn't realize, Vince, that 80% of active pharmaceutical ingredients, the stuff that makes medicine work, is sourced from China. And people are uncomfortable with understanding what that means. If China wanted to shut that valve off, they could. I would be very drastic. I'm not suggesting that's the first policy option, but they have history of intervening in markets in the past. So there's a question about, do we need a national stockpile for personal protective gear, right? So when the next pandemic comes, we have latex gloves and face masks and face shields, so we can deliver healthcare. These are low value goods, but it turns out you can't deliver healthcare without them, right? So they're clearly is shifting in the appreciation of the risk in global supply chains and what we're willing to tolerate going forward. Another example I like to cite is rare earth minerals are critical for technology products like the one that we're using on this call today, also critical for some of our military equipment. And China has a 80% monopoly of the world's supply of rare earth minerals. Not because they don't exist in other places, they do, but we don't want it to dig mines in the United States, right? We're happy to let China dig the mines. And so we put ourselves in a place of maybe some discomfort. So let me just generally then address the topic of risk. I'll begin with you, Vince, and maybe we'll go to Caroline and then Piyush to wrap up on this segment. Do we believe that this last 2 years has caused us to fundamentally rethink how much risk we're willing to accept? Is that going to change what we're willing to do going forward in supply generally?
So I think from a risk standpoint, I see two pieces here. One is what I would call your supply chain fitness. And just like your personal fitness, this is something that you, as an organization, need to constantly be assessing your risk. So from a pharma standpoint, we've done a lot of work as it relates to dual sourcing APIs and making sure that we have multiple sources. Now, one of the learnings we've had as we've gone through the pandemic is it's also not only having the dual sources, but to the point around protectionism or border controls, where are those second sources located? So it definitely causes you to think about, where else should I locate my sources? And additionally, given in a regulated industry, having second sources typically takes a lot of time. There are many regulatory filings. And so in some cases, you've had to prioritize, but we are looking to make investments in other areas where we maybe typically like single-use technologies, where maybe there wasn't a focus before. How do we have more systematic programs to buy down the risk, second source, and in some cases, triple source? And that does a couple things. I mean, one, along with protecting supply and ultimately the patient, it also provides, I truly believe from a competition standpoint, having competition, buying down the risk will also help what I call the leaky bucket and this inflation. So just making sure that we continue to drive competition where we can will not only ensure supply, but also will help with the cost structure. From a proactive risk management standpoint, we do have to continue to map our supply chains. And we've done a lot of work as it relates to, where our materials are sourced from, who the suppliers are. And I think we've done some really good work in the industry in general is further mapping upstream to the tier 2s and tier 3s. So there's some really cool supply chain visualization software that's really important, that you further see where your risk exposure is, how much revenue is coming from some of the sites beyond just the supply itself, and being able to proactively monitor capacity, proactively monitor the financial risk. You got to have really strong cost models and really understand the changing dynamics that we're seeing across, including we talked about some of the tariffs we're going to be seeing more and more on the ESG front from a sustainability standpoint. So continuing to invest in your teams, continuing to invest in new technologies, thinking about how technologies can complement each other and further push the boundaries. I'll give you a quick story. I know when back in 2000, I was coming back from Warsaw. They were getting ready to shut the door out of Warsaw. The pandemic was just starting to brew. I called my head of risk management and said, this is different. Being in pharmaceuticals and supply chain, have dealt through Katrina, Fukushima, the Great Recession, but this was different. And it actually took us, well, we have great systems. It took us almost 2 weeks to really get a complete picture on being able to understand what materials we got out of China, what suppliers they were associated with, and what was our current inventory levels. That obviously then allowed us to really think about how could the systems work for us? What other types of technologies can we link together? And what we've been able to build is being able to have better visualization of our supply chain, to where as things have kind of evolved, we can now in hours, effectively, when there is a change, we have a natural disaster, we have a geopolitical event, we could very quickly get to the information, including real-time access to our inventory systems to understand how much runway we have, what sort of contingencies should we put in place. So it really helps driving those insights so we can really make decisive decisions to protect supply for our patients and consumers.
That sounds like leading edge practice to me, Vince. I think in some ways, the CEO of Microsoft said in an earnings call last year that we've done 2 years worth of digitalization in 2 months, in this economy. And I think in supply chain, we've experienced that too. We've been forced to get leaner, more agile, more nimble, to understand our risk better. Caroline, do you have a perspective on that from a trade point of view? And then Piyush, I'll ask you to wrap up.
Yeah, sure. And Vince, first, congratulations. 2 weeks is actually pretty good from the data we were seeing. But there are different ways of dealing with risk, and holding inventories is one. And that's unfortunately also feeding into the demand boom right now and making it harder for others to find the supplies they need. So there's a coordination problem when everyone's doing it at the same time. Certainly it works for volatile goods. That's why we do it for oil. And perhaps there are others like face masks and gloves and things like that we'd want to do it in the future for health reasons. The other is diversifying suppliers, as Vince mentioned. So we know in finance, diversity is the way to reduce risk, and it can in trade as well. But there's a huge cost to it, because for complex goods like cars or electronics or pharmaceuticals, you need all sorts of security compliances, regulations to be met, and you need this relationship, and it takes time to build that trust as well. So I just don't see it happening. In research I've done with colleagues at the World Bank, we looked at what happened after the earthquake in Japan in 2011. Did companies that were affected by that in autos and electronics diversify after, because they knew they could be hit? So when they were really dependent on Japan for a specific product, they did shift out of Japan over time, but they didn't diversify. They shifted to a different supplier and a low-cost supplier. But their capital was destroyed, so they had to move anyway. Rather than rebuild, they shifted somewhere else. So I think dual sourcing, as was mentioned, perhaps, but I don't see a huge amount of diversity. The other thing that's mentioned sometimes is the reshoring or nearshoring. But to me, that's a non-starter, because why do you want all your eggs in one basket? And the one that might not produce the most efficiently at that. So global supply chains have really helped us during this crisis, because we're producing each component where it can be produced at the lowest cost. And then finally, I really like what Vince said about technology, and the point you made, Tom, about what Microsoft said. That's where I see the big change, is mapping supply chains. And we heard lots of companies talking about that at the beginning of the crisis, just to understand, so you can shift around quickly, know who all your suppliers of different parts are, have that communication. And we of course have a lot more tools now for that kind of process as well. So I think that's the direction, more than reshoring inventories, and then maybe a bit of dual sourcing.
If I could come in on that, Tom. Hey, look, the risk management manuals that were written, at least in the last 2 or 3 decades, didn't really have a chapter for the kind of pandemic that we are experiencing, right? So it really has turned the trade on its head. And it's the sequential, if it's the sequential, if it was one after another, it could be managed. The fact that all of these things are happening at the same time is what's making it much harder. And the uncertainty element that Caroline mentioned was exactly right? There's no end in sight in some cases. But as it relates to risk, I'll try to underscore a few things that were mentioned and maybe add a few as well. The 3 elements in my mind around risk management, around manufacturing risk management, and there's a lot of talk about reshoring and things like that. And whether it's principle or practice, I think the jury is still out, in my opinion. I think that the externalities that develop by having networks of manufacturing that date back decades are hard to compete. And when things start to get redistributed, the immediate response of the incumbents is to continue to add more value, which makes the inertia even harder to move. So I think there will continue to be some redistribution of manufacturing out of traditional centers like China. I don't see a very dramatic shift in risk management as it relates to manufacturing. But instead, what may be more emerging is the whole concept that came out of the old Russia, which is near abroad, right? Like Mexico is near abroad for US, and you can take other examples in Eastern Europe or even in Asia. And I think that's what you're beginning to emerge and see more dominantly. So that's on manufacturing risk. On sourcing risk, I think Vince mentioned it already, de-risking the supply chain by having more degrees of freedom, more traceability. And I also think there's an element of using the data that we already have more intelligently, whether it's for forecasting demand or to really map out our supply chain. I think we have benefited for a while from having a lot of data available to us, how we use that data to make intelligent decisions, whether it's something that's on the BOM or it's in the sub-tier BOM, and how you use that to create risk management strategies, I think is going to be emergent. The third element of risk, which I think we've not touched on, but is critically important, is the logistics of the 3PL network that plays into the supply chain. Oftentimes that was considered to be a given, but whether it's the port congestions in LA or exogenous factors like Ever Given being wedged in the Suez Canal and $2 billion or $10 billion of commerce being impacted a day, it's really sort of shown us a very different side of logistics. If you think about the belly capacity that has come down because of reduced passenger travel and what that does to the logistics network, you talked about the trucking industry and how they're facing unprecedented shortages in terms of drivers. I think the redundancy or the resiliency that we've traditionally thought in our sourcing supply chain for components and devices and capital equipment, I think we have to take the same mindset on risk management for logistics. And it has an added complexity of cross-trade agreements and trade issues that further complicate it. So I really think it's a three-headed monster: manufacturing risk, supply chain and sourcing risk, and then risk that exists in the area of logistics, and how you bring together a playbook that helps you address all three simultaneously over the next few years.
That's very interesting. I want to bring up and follow up on a topic that's been mentioned briefly. They're interrelated concepts, really. One is ESG, or environmental, social, and governance, which is a new prism for evaluating how value is created by a company, right? It's a theory that companies who score well in these dimensions tend to be more profitable, for instance. And then that's closely related to the overall issue of climate change. And I bring it up because it seems to me that the person who leads the function, chief procurement officer, the chief supply chain officer, owns most of this agenda on behalf of the company. I've also heard data that suggests that in terms of reducing carbon emissions as one specific element, the most potential for achieving our net zero goals or reducing carbon emission generally occurs in what is called scope 3, which is our supply ecosystems, our supply networks that we manage. So it's the carbon emissions from manufacturing from our supplier, from moving our goods from our supplier to a warehouse or a distribution center and so forth. Do you believe that the agenda is changing for companies in a way that is putting the CPO or CSEO more in the center of these strategic issues that companies are confronting? Why don't I begin with you, Vince, this time, and then Piyush, and then Caroline to wrap it up.
No, Tom, I think the number I've seen, and it's pretty correlated to what we see at GSK, but it's around 85% of a company's carbon emissions come from scope 3. And it's more and more, it's just the right thing to do from a trust agenda. And from a GSK standpoint, we actually have a 2030 net carbon zero, net nature positive commitment that we're working towards. And that's going to really require significant, especially in the pharma industry, where we have a lot of work to do as relates to maybe some of the other industries that have what I would say a head start. So that's a pretty ambitious goal. And it is something that when we think about what we buy, that basically what we buy today as organizations is going to be different. And it's also going to be produced differently on how we buy in the future. And that to me is the opportunity that we have to do as supply chain procurement professionals. And it's really working with our supply partners to really make sure we have clear glide paths, action plans, because it's just the right thing to do for the planet. And there's so much to be done here. I also think as it relates to the ESG, we have to break the paradigm that just because it's sustainable, it has to cost more money. And I think we have to really challenge that assumption. I think as companies and industry move towards more sustainable ways of producing goods and services, that's not necessarily the case. And I could give an example with GSK, for example. We're currently, we make toothpaste tubes. Sensodyne's a key franchise for us, and we're working with one of our key suppliers. And we basically are converting over 1 billion toothpaste tubes using recyclable laminates that are going to go into that. So these are the kind of things that are just, it's expected. It's the right thing to do for the planet. And from a supply chain standpoint, it's just good stewardship.
Yeah. Piyush, you see it the same way?
Yes, I had a chance to talk on this at one of our customer events, and I still strongly believe that the future of supply chain is circular. And the elements of that, the obvious is using waste streams as a source of new supply, the ability to reuse and recycle. While it makes economic sense, I think there is a broader imperative. That is, more and more, we see purchase decisions being linked to the ESG agenda that the company has. Traditionally, we used to see, outside of even federal contracts, we used to see 30, 40, 50% of the RFQs requiring some level of, elements of sustainability. Now, I think the number is maybe double of that. And I only see that going forward. I have 2 kids, and I talk to them about, how they make their purchase decisions. And it's interesting to me that the generations that are coming behind us are looking for a reason to purchase from certain brands and companies that is very much linked to not just the profit, but I think the profit is now riding shotgun to the planet. And I think that will continue to be a need in the future as well. And then finally, if you think about the ESG agenda and who owns it, which was one element of your question, I think it has to be driven top down. It has to be something that has to be codified in the ethos of what you do as a company, because traditional acquisition cost models are no longer going to be valid. In my sense, there is life cycle cost analysis that needs to sort of supersede or maybe even supplement acquisition cost, because I think to Vince's point, sustainability at a cost is not very scalable. And therefore, we have to find new ways of being able to look at the value delivery of the area under the curve, and that has to go through the life cycle from acquisition to asset recovery.
Caroline, what are the economics of a circular economy? And I was talking to the CPO of Ball Corporation, best known for all the aluminum cans they make. And aluminum essentially is an infinitely recyclable package. There's a little bit of loss in the melt, but not very much. And 75% of all aluminum ever produced is still in use today. So we've been in pharmaceuticals, we were very innovative in bringing a vaccine to market as fast as we did, right? On our new technology platform, the mRNA platform. There's a role for innovation, isn't there? If we're going to pursue an ESG agenda, and if that's seen as being a good global citizen, an imperative for companies, innovation is going to have to be part of the answer, isn't it?
Yeah, absolutely. I think the issue is about incentives. And that's where policies are going to be really, really important, because we need to get the prices right. So we should be pricing carbon and everything. I think right now that's probably a political non-starter in the US, but it's working through regulation. And then the EU, I think, will move more towards a carbon tax, and hopefully both areas will also implement a carbon border adjustment to prevent leakage, so that you don't import those high carbon goods from outside, so everyone's on a level playing field. So I think policy will be really critical about getting the prices right and getting firms to act. And also the expectations of policies, because we're starting to see in finance more investment into ESG, which I think is also pushing companies in that direction. But, you know, to be honest, I think policy has to move a lot quicker in order to really get the company action. We know what has to happen, but it has been moving way too slow. We're always behind where we want to be. The money that was supposed to go to help developing countries and all those upstream polluters you have hasn't materialized. So if anything, we just need to move a lot more quickly.
There was an argument made in the not too distant past that, countries like the United States benefited, from high carbon emissions and during their stages of early economic development. We've moved to more of a knowledge-based economy in this country now. And we shouldn't deprive emerging countries, emerging economies from their opportunity to benefit from high carbon emission kinds of industries and so forth as they move through a stage of development. And it brings to mind what we're seeing happen in the global tax regime. There's been a push to harmonize corporate taxation around countries around the world so that there isn't a race to the bottom. So we don't have an Ireland out there that is racing to produce the lowest corporate taxes. And I wonder if the carbon tax and the cost of carbon isn't something that has to be handled similarly. It sounds like you would think so, Caroline, that countries have to agree to a standard approach so that we aren't disproportionately impacting negatively or positively certain players in the global economy versus others.
Yeah, I think that's absolutely right. So historically, the industrialized countries, precisely because or the advanced countries, we used to call them industrialized countries, and precisely because they industrialized have contributed the most to climate change. So in that sense, that's why we do owe the 100 billion plus to the rest of the world. We've ruined the planet for everyone. But currently, if you look at the top 10 emitters, only half are OECD countries. So we do have big other emerging market countries out there that are big contributors. So it's not something that can be done in only part of the world. The EU contributes less than 10% of global emissions. They can't do it alone if they're the leader on this. We all have to work together. So definitely it's an area where we need cooperation, but we also need the rich countries to pay for it and to make room for developing countries to still trade. So one way, if there is a carbon border adjustment, would be something like the generalized system of preferences, which allow us to import goods from the least developing countries without them facing normal tariffs, duty-free. And I think one could phase in any kind of carbon border adjustment that way while providing support for other countries to move towards more sustainable ways of manufacturing.
It seems like the equation is getting more complex for those of us in supply management. It used to be about total cost of ownership, and it was pretty easy to figure that out, right? And it was about labor arbitrage and finding the lowest cost manufacturing country. Now we have to take into account taxes and tariffs, potential carbon taxes, changing assumptions about geopolitical conditions. The equation is getting more complex, I think, and we're going to be expected to manage it. I think that, Piyush, is one of the reasons why your point about managing data flows is going to become critical for supply management in the future, because in this complex environment, settling on the right answer is not going to be necessarily easy. It's going to take some complex analysis. I wonder if you agree with me that more of our responsibilities are going to involve analyzing and understanding the implications of data flows and acting on those.
Yeah, no, I actually think that's going to be critical. And I'll take a for instance to underscore that point, right? If you think about the demand uncertainty that we've talked about, and a way to manage through that in the supply chain is more and more of our suppliers are looking for longer term forecasts, especially capital intensive industries are looking to figure out how they will fill their capacity in the long term and justify the investments that are being required to make to scale capacity in the future. Given the uncertainty in the demand environment and some level of disconnect from historical demand patterns, I think intuition and just our current playbook and our ability to forecast the future based on past demand patterns is not going to be enough.
Right.
So we're going to have to start employing more sophisticated intelligence, whether it's statistical forecasting, algorithms, models that account for causal factors, and all of that, I think, is premised on data, right? Good data and good transparent data that crosses over supply chain boundaries, right? Whether it's in the sub-tier, et cetera. So back to my point of using the data that we have more intelligently and being able to harness the intelligence that allows us to make the right critical decisions in a timely fashion. And I think that I think is going to be an important element.
Okay. Well, we have a number of questions that have come in, and I want to turn to some of the questions that have come directly from the audience. And one of them looks like it came in from Dan Bartlett at Dan Bartel at Schneider Electric. He has a question, a practical question about those scope 3 emissions that we talked about. How do you measure the carbon emissions in movement and shipping from your suppliers? And does that same effort or expectation apply to logistics companies and industries as well? And then another way of framing this question is telling your suppliers you expect them to change their behavior is often a difficult conversation to have to begin with, right? You're already beating me up on price and you want me to do it in a different way that's going to cost me more money. What's my incentive for doing that? So how do you have that conversation, and how do you begin to get to real measurements in terms of scope 3 emissions anyway? Vince, it sounds like you're beginning to kind of scope that problem at GSK.
The data is definitely a challenge, and coming up with a common denominator and just how you collect it. So right now for us, it's been pretty manual. It's been using, traditional data collection methods to get some baseline, some assumptions that we've made. We're starting now to invest with certain collaborations where they're more industry specific, so that first of all, to make it easier for the suppliers, so they don't have to respond to 20 different of the same type of data sheets. Mm-hmm. And I think that's going to further help with the transparency on how we measure and ultimately performance manage down to the objectives that we have. That's probably the key area that we need to do. Now, answering your questions around, Tom, around the partnership, it really goes back to, one of the points that I think about is you can't run a supply chain alone. And of course, that's why we use the term a supply chain, because of the interconnectivity, but really having the right partners and how you select those partners, and how do you, just like any other technical requirements, business requirements, we ultimately have to get to where and we have a lot of work to do, but we need to get to where sustainability just becomes another business requirement that needs to be factored in. And if it's not properly managed, like in pharma, you have to be able to manage according to current good manufacturing practices. That's just kind of the ticket to the game. And I think over time, that's, one, around having the right partnerships, really making that part of your strategic agenda with your suppliers and your supply partners. And then ultimately over time, just making it part of, this is ultimately what is expected from our patients, from our customers, from the governments that we work in, is how I see this playing out over the coming years.
Okay. I'm curious about, in your industry in particular, Vince, but I thought this was rather remarkable. We had national governments bidding against one another to gain access to vaccines, right, in the early days of the pandemic. And in fact, there was a fairly famous case coming out of France where a French pharma company had committed its allocation, its allotment of first wave of vaccines to the United States, and France was fairly livid about that. Kind of a famous example. So do we see, we've talked about an emerging wave of nationalism, which is kind of going against the grain of the movement in geopolitics over the last couple of decades. Do you think nationalism is going to be something that it's going to be heavily influencing how we operate supply chains, more so than it has been in the past?
I think the reality is the answer is yes, especially in pharmaceuticals. With that being said, though, the importance of trading blocks and how you work with other countries, how you work with your supply base on where their locations are effectively set up, how you partner with them to think about where the supply of the future needs to come from. And ultimately, from a pharma standpoint, well, you could see certain polls to kind of nationalize. It goes back to the conversation we had earlier. The reality of the pharma industry, it is a global industry that requires a global supply base. Mm-hmm. And while we need to think about those implications that we're talking about, we do need to factor that into our sourcing strategies, into our supply chain strategies, absolutely. But the reality is we need to kind of also work with the policymakers, explain some of the challenges that we have and what it would take, what type of investments would be needed. But that absolutely needs to be part of key considerations as you look at strategy.
Okay. And Piyush, in your industry, electronics industry, broadly speaking, it's not just semiconductors. We've got shortages of all kinds of components, capacitors, resistors, transistors, and there seems to be a chronic, it seems to me, we've got non-traditional sources of demand have sprung up for many of these things, right? So it's not just laptops and cell phones anymore, it's automobiles and refrigerators too. And production hasn't, this is the point that Caroline made earlier, production really hasn't kept pace with the emerging sources of demand. And the capital stocks are relatively fixed in the short term. Why is that? Why do we seem to go through these periodic cycles of underproduction? And is it because we're waiting to see if the demand is going to prove out to remain at that new level? You talked about the difficulty of demand planning already, but what do you see as the cyclicality of that industry in particular?
Yeah, no, the feast and famine that you're referring to, or the bullwhip, if you go to the more traditional supply chain nomenclature, I think has played out quite a bit. Also, the lines between industries are blurring. I mean, if you think about a car of today, frankly, there's more electronic componentry than in most cars than our handheld devices of previous years. And the profit pools are different, right? So if you think about what makes it complex and why it creates the feast of famine is the traditional profit pools in the industry. And if I just take automotive as an example, right? There's a lot written about how the pullback in the automotive industry And then the resurgence of that demand was a big catalyst to the semicon issues that we are seeing today. So I think as we think about how this will play into the future and how those demand signals get proliferated into the extended supply chain, I think we're going to have to do more detailed assessments of the value chain within the extended supply chain that we have, because traditional partners and the labor cost arbitrage or the cost equation being solved in itself within your industry will not be sufficient, right? You have to be able to scan the environment for where else does that same capacity become fungible. The classic example of this has been the LCD industry, right? When there was a push away from cathode ray to flat panel, both in the devices that we carry for productivity and for the consumer electronics, the same piece of glass had very, very different dollars per diagonal inch, depending on where you were utilizing it, even including pachinko machines, right? So I'm taking that example and saying, if we extrapolate from that, I think the practitioners of the future in supply chain would have to scan the environment for more than just your industry. And then the profit pool analysis will allow you to see the behavior that will drive allocation decisions.
That's very interesting. There's Caroline, I'm sure you could comment on this. There seems to be a school of thought among economists that while we traditionally thought of firms as being classified as either a manufacturing firm or a services firm, there's sort of an emerging idea of a third category, the factoryless goods producer. And a good example of that might be a Google, right, or an Apple. They want to be asset-light companies. They don't want to own a manufacturing base. The profit pools for Apple at the R&D level, right, and owning the brand, and they want to contract out the low margin manufacturing. And I wonder if this is something that we've spent most of the last century vertically integrating our businesses, right, and becoming more efficient. And so I wonder if that's going to be a continuing driver of the development of supply chains going forward, and people are going to tend to want to focus on the knowledge enterprises that create profit and less of owning the assets associated with manufacturing goods. Caroline, what's your view on that?
Well, I think that you're touching on something else that we haven't discussed here, which is services. So services are a much bigger part of the global economy, and what did you say, 80-something% of the US economy. But we sit here and we talk a lot about trade and goods. We focus on manufacturing and manufacturing in the US. And services are becoming increasingly tradable. And the new ways of communicating and delivering could completely change the landscape. So during the pandemic, I think all of us have had the experience of a virtual doctor's visit. Well, why do I have to see a doctor in my town? Why do I even have to see a doctor in my country? And if insurance were portable, one could imagine that industry being vastly disrupted. And there are plenty of others that you can think about. So I think I would change it to rather, I think it's hard to talk about vertical and horizontal, and I'm not an expert in that, and I know people are thinking about it, but we've been, for a long time, there's been a discussion in trade about this coming boom in services trade that's going to happen, yet services have remained around 20% of trade flows. And I think the question is this disruption something that's going to change that? Education is another. Increasingly, our students are actually in surveys saying they like remote classes. Are we going to have a lot more cross-border education without people moving? So I think there's a whole new area that can open up that that we should be thinking a lot more about.
That's very interesting. I'm familiar to a slight degree with Paul Romer and his thinking about endogenous growth theory. And I think the key insight that he had there was that there are these non-rival risk goods, right? We've classically thought if I'm talking to my doctor, I'm the only person who can consume my doctor's attention. And another patient doesn't have access to the doctor at the same time. But it's not true with a lot of our IP-based products and services, right? I can listen to my favorite Beatles song, and so can 100 million people around the world at the same time on Spotify. So it would be interesting to think that the way we think of the economy at the nation state level still seems to be kind of geography bound. We still think about borders, and we still think about, capturing value within the borders of our country. But I can envision a world, particularly through technology, where borders become meaningless, and it's access to the consumer wherever he or she happens to live. And kind of a fascinating scenario to contemplate. I think we're going to have to end on that very, very interesting and tantalizing idea about where the economies might be moving globally, because we've come to our time limit. But what an amazing conversation! Thank you very much for joining me on this panel today. It's my privilege to be asked to be a part of it. I hope the audience got as much out of this conversation as I did. I believe that the slides, if you're interested in them, the slides will be made available to people who wanted to see that. There are 1 or 2 questions about getting a look at that data. I'm happy to share that. And thanks to everybody at ISEI for putting on such a great opportunity to think about the future of supply management and where we're all headed as a profession.
Great. Thank you very much, Tom. Thank you also, Caroline, Piyush, and Vince. It is really fascinating to hear both in the technology industry as well as the pharmaceutical industry, in addition to the trade economics perspective. I would like to also thank our staff, Jeremy, as well as Heidi and Melanie, and also someone behind the curtain, the giant behind the curtain. Big thanks to Helen too. And also, last but not least, like Tom said, we will post the edited videos on our LinkedIn ISEI channel. Please follow us on the LinkedIn. In addition, next week, we have another great event coming on the Oceanside chat, talking with Helen and Tom Linton. So please follow us on that. And thank you, everyone, for joining. Thank you.